concept. How overlapping zones. Module 2 of the OTC Blueprint course. In this lesson, lesson 6, we are diving into an essential topic, zone qualifiers. Zone qualifiers allow us to systematically evaluate and rate the quality of a zone, so we can prioritize the best opportunities and avoid weaker setup. We will break down zone qualifiers into a few key focus areas. Zone structure. What makes a zone structurally strong? The origin of a zone. Why understanding the origin of price movement matters. Location. How the zone position within the higher time frame context affects its quality. The level on top of level concept. How overlapping zones can strengthen or weaken a trade setup. By the end of this lesson, you'll be able to rate zones objectively and use that information to make better trading decisions. Let's get started. By now, you have learned how to identify supply and demand zones. By the next logical question is this: how do we distinguish between mediocre and good zones? After all, not all zones are created equal. That's where zone qualifiers come in. Zone qualifiers enable us to evaluate and validate zones, ensuring that we focus only on high probability areas where unfilled institutional orders are most likely to exist. To achieve low risk, high reward, and high probability trade setup, all zone qualifiers must be met before we consider taking a trade. This discipline, rules-based approach, not only ensures consistency, but also aligns our trades with the institutional footprint, giving us the edge needed for long-term profitability. Let's take a moment to reflect on why zone qualifiers are so important. They serve three key purposes: objectivity and consistency. Zone qualifiers create a systematic, rule-based approach to evaluating trades. This eliminates emotions and subjectivity, making the decision-making process clear and mechanical. Performance track. By using qualifiers, every decision can be measured and analyzed objectively in your trading log. This allows you to improve over time and refine your strategy with confidence. Decision simplification. With a structured framework in place, deciding whether to trade or to intentionally pass on a zone becomes straightforward and logical. Let's get into the specifics and start breaking down how we rate zones. As mentioned earlier, zone qualifiers can be grouped into three main categories: nature, or origin, location, and structure. Each category includes different criteria for evaluating the quality of a zone, giving us a total of 6 zone qualifiers to work with. It's entirely up to you to decide which or how many of these qualifiers you want to include in your trade plan. Let's quickly outline all 6. Then we will take a deeper look at each zone. Zone structure focuses on the departure, the strength of the leg out, and the base duration, the stability of the zone. The departure of price from a level is extremely important, as it reveals the market's momentum away from the zone. Zone nature considers freshness, which refers to price action to the right of the zone, and originality, which looks at price action to the left. These aspects help determine how unique and untouched the zone is. Zone location evaluates a zone's profit margin and how price approaches or arrives at the zone. Let us now look at each zone qualifier in more detail. Departure looks at how price leaves a zone and evaluates the leg out. The stronger, more explosive the leg out, the better. Think of this departure like touching a hot stove. The hotter it is, the faster you yank your hand away. In trading, the speed and size of the move indicates an intense imbalance, almost like the market has touched something burning hot and recoiled sharply. We look for these rapid, explosive moves to find institutional footprint, because big players are the ones causing the swift shifts. To capture them, we follow simple rules in two ways. The conservative approach, pictured here as 1 on the left, demands abnormally large, explosive candles, each having at least 70% of its total range in the body. If you're comfortable being a bit more aggressive, especially on lower time frames, you can allow a candle that doesn't meet that 70% ratio as long as it's abnormally large and followed by at least one decisive candle. This is a second approach, pictured here, labeled 2. To establish what is considered abnormally large, you have to compare the leg out to other previous candles, no matter the approach. Size matters most. Let's look at some examples. Let's walk through a few examples to clarify what makes a great, acceptable, or poor quality leg out in both supply and demand. A great leg out is like a powerful surge, steep, sharp, and full of momentum. It's unmistakable. In this case, either buyers or sellers are clearly in control, and the move carries decisively forward, leaving no room for doubt about the direction. This is a kind of leg out we aim for, a clear sign of institutional activity. An acceptable leg out, while not as extreme, still shows strong, clear price movement. The follow-through is there, even if it lacks the explosiveness of the best scenarios. It's solid, and while it's not ideal, it can still qualify as a decent trade setup. A poor quality leg out, however, is a different story. Imagine a weak, choppy movement that barely covers ground. Instead of a sharp push, the price seems to stair-step its way down for supply or up for demand. This type of leg out lacks the urgency and imbalance we associate with institutional activity, making it unacceptable for a high probability trade. Let us now look at some real-life examples during another practical application. Welcome traders to my practical application. Today we will talk about zone qualifiers, and here we'll talk about departure. It's the first one. Let's go into the charts, and we're using our Campus Fund Trading platform. That's TradingView. We can execute and analyze all of our assets. Okay, step number one, or not step number one, it is a zone qualifier number one as a departure. We have to check the leg out candles. We are looking for clear, powerful, dominant candles, okay? Depends on the zone. For a supply zone, of course, big red, explosive or decisive candles, a clear drop. For demand zones, of course, green candles, big ones, explosive, decisive. Let me identify a zone here, and we will go with this one here. It's Bitcoin on the daily time frame. Let me use our proximal and distal line, right? That's our zone here. And now focus on the leg out candles. And you can see they are not indecisive candles, right? They are not really huge wicks. It's green candle. They are abnormally bigger than the surrounding. Clear, explosive. Look, the price rallied up all the way to the upside, meaning this is really powerful, okay, dominant to one or into one direction, here to the upside. The departure is amazing here for this example. Great. That was an example for the zone qualifier departure. See you in the next zone qualifier practical application. Now that we have mastered the importance of the leg out, let's shift focus to another crucial zone structure qualifier, base duration. Why is the base so important? The base represents the origin of the imbalance, the point where unfilled institutional orders are likely concentrated. It's also the foundation for drawing your distal and proximal line, which determine how you place your stop, entry, target, set. In other words, if the base is poor quality, the entire zone loses its reliability. To evaluate a base, we need to ask two key questions. How much time did price spend in the base, and how many candles formed within it? The duration of price within the base directly correlates to the likelihood of unfilled versus filled orders. Think of it like a store with limited stock. If too much time passes, most items Orders get purchased, leaving little behind. A base with too many candles signals that institutions had more time to fill their order, reducing the imbalance. On the other hand, a compact base with fewer candles suggests less time for fulfillment, meaning a higher probability of unfilled orders still being present. So, how do we ensure objectivity? A good rule of thumb is to look for bases consisting of 1 to 5 candles. Smaller, focused bases reflect areas of significant imbalance with minimal institutional order fulfillment, increasing the likelihood of unfilled orders. When assessing a base, look for patterns like pin bars or candles with small bodies and fairly larger wicks, just not excessively large. Ideally, you're seeking zones with 1 to 6 candles. So, in rare cases, zones with 8 to 10 candles may still qualify based on other context factors. It's essential to remember that these rules serve as guidelines, not rigid absolute. While a base with 2 candles may often outperform one with 6, the reverse could be true depending on the broader context. That's why no single rule should ever be used in isolation. Zone quality must always be assessed holistically. Finally, think of these rules as a structured starting point. As you gain experience, your understanding will evolve into a more nuanced framework, allowing for flexibility based on context. But for now, stick to this clear-cut approach, which ensures objectivity while building the foundation for long-term success. While base duration rules are crucial, it's equally important to ensure the base isn't just a speed bump. A quality base reflects a genuine battle between buyers and sellers, hinting at the presence of unfilled institutional orders. On the other hand, speed bumps are deceptive. They may look like zones of imbalance, but don't hold the same significance. So, what exactly are speed bumps? These are levels on the chart, while appearing like supply or demand zones, lack the qualities of a true imbalance. Unlike real zones, speed bumps don't originate a move or signify the initial momentum of an imbalance. Instead, they are simply brief pauses during a strong price movement in either direction. Think of them as a rest stop on the long journey, not the starting point, not the destination, just a temporary halt. Speed bumps are easy to spot if you know what to look for. They typically take the form of rally-based rallies or drop-based drops and share a few telltale characteristics. Their base consists of only one candle. That single base candle matches the color of the momentum move, green for demand zones or red for supply zones. The candle in the base has a larger body, which is the opposite of what we want to see in a quality zone like a pin bar. By learning to recognize and avoid speed bumps, you'll refine your focus on genuine zones of imbalance. Let us now jump into the charts for some practical application. Today, we will talk about the zone qualifier base duration. Let's go into the charts. And here, we are using our Campus Fund trading platform. We can analyze and execute all of our trades here. It's TradingView, by the way. Do you guys remember on this example? We talked already about it. Here we talked about the departure. Today, we will talk about the base duration. Meaning, we have to check the basing candles between the leg in and the leg out candles. Okay? And here, look at this. We have a lot of candles here. And remember, we have clear rules, right? 1 to 3 candles are great. 3 to 6 indecisive candles are acceptable. And more than 6 are not acceptable. And let's count it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We have 11 basing candles between the leg in and the leg out here. 11. That's definitely more than 6, right? Not acceptable. Maybe. Please remember the base duration is always our weakest rule. Okay, we have to check all the zone qualifiers, and maybe it is just the base duration what's not the best of the best. We have to check the context, okay? And in this case, yes, we have 11. More than 6 are not acceptable, but let's talk about the other zone qualifiers a little bit later, and then maybe it's still a valid setup or not. Okay, this was my practical application about the base duration. See you in the next one. Freshness refers to whether or not price has revisited a zone after its creation, and consequently whether some of the unfilled orders within that zone have already been filled. This concept is critical in determining the likelihood of a zone's success. The fresher the zone, the greater the probability that unfilled institutional orders remain, offering a higher chance of success for a trade. There are 3 distinct categories of freshness to consider when evaluating zones, each representing a different level of risk and potential success. Let's walk through them step by step. The first category represents a zone that is 100% fresh, even when measured using the wider version of the zone. In this case, price has never returned to the zone since its creation. This is the most conservative and reliable approach to freshness. A completely untouched zone ensures that all institutional unfilled orders remain intact, making it the highest probability setup. The second category occurs when price has tested the wider version of the zone, but not the preferred version. In simpler terms, price has touched the edges of the zone but hasn't penetrated deeply enough to test the core, preferred version. While this setup is less ideal, it may still hold some unfilled orders. However, it introduces uncertainty how many of those unfilled orders are still left if price revisits the zone. For higher time frames, such as HTF supply or demand zones, this setup can still be considered as higher timeframes inherently contain more unfilled orders and can work multiple times. As you gain experience, and depending on the type of income you are pursuing, monthly, weekly, or daily, you may choose to adapt this rule. For instance, monthly income trades using weekly LTF zones might tolerate this level of freshness. But for daily income, you should remain strict and avoid zones that have been tested on the wider version. The third category represents a zone where price has tested or touched the preferred version. This is unacceptable. Once price has entered and tested the preferred version of the zone, most unfilled orders will have been consumed, leaving very little opportunity for high probability trade. Trading the second touch significantly reduces the likelihood of success, as the imbalance in the zone has already been largely resolved. The key takeaway here is simple. The fresher the zone, the higher the probability of success. Untouched zones are more likely to contain significant unfilled institutional orders, giving you the edge needed for consistent, low risk, high reward trade. By adhering to this freshness rule, you ensure that you're focusing on the most reliable opportunities in the market. It is important to remember that your rules for freshness may differ based on what time frame you are looking at. For higher time frames, HTF, the rules are more lenient. Up to 25% of the preferred version of a zone can be tested. HTF zones tend to contain more unfilled orders, so even with a partial test, they can still hold up. For lower time frames, LTF, however, the rules are much stricter. The wider version of the zone must not be touched at all. This conservative approach ensures the highest probability of success and is a rule you should stick to when starting out. As you gain experience, you might consider adjusting this rule to allow no tests on the preferred version of the zone. But this adjustment should only happen if your trade log clearly shows that it works with your strategy, particularly for weekly or monthly income trading. Becoming masters of zone analysis means developing the ability to look to the right of our zones and ensuring they are fresh, untouched, and untested by price. However, for lower time frame zones, it is equally important to look left to determine the origin of a zone. Every LTF zone falls into one of two categories: original or non-original. An original zone is one that hasn't been caused by a reaction to another zone to its left. In contrast, a non-original zone is created as a result of a reaction to an earlier zone. For instance, our U-shaped formation, rally base drop, RBD, or drop base rally, DBR, are often non-original, as they tend to be the result of a previous zone. The exception, U-shaped formations that occur at all-time highs or low. Conversely, formations like rally base rally, RBR, and drop base drop, DBD, are usually original, unless they are part of a larger support of resistance area in the big picture. Originality can feel complex at first, which is why we won't set any hard rules around it in the beginning. Your zones don't necessarily need to be original to trade them. Instead, originality helps us better understand the context of our LTF zones and the connection to the bigger picture. To drive this point home, let's explore freshness and originality in a practical application. Welcome traders to my practical application. Today we'll talk about the zone qualifier's freshness with its originality. Let's go into our Campus Fund Trading platform. That's TradingView. We can analyze and execute all of our trades here. Okay, let's start with a zone qualifier freshness. For that, we have to move our proximal line, right? From the preferred version to the wider version. And now we have to looking to the right, okay? Whenever price tested our zone, you can see never happened, right? It was close, tested our zone almost, but almost, right? We never tested it, just almost. Great. This zone is 100% fresh. We expect a lot of institutional unfilled buying orders here in this zone. The reason is, never tested our zone. Great. We have a fresh zone. What's about the originality? Is this zone original or not? Let's go to the left, and we will use a horizontal line for that. Let's go to the left. We can see that's not in an all-time high, right? We have another candles here. That's great. And you can see there is nothing, that's just a wick, but we have a little bit more below. That's a picture perfect supply zone, right? It's a rally base drop. Let me highlight this for you. I'll go with the whole zone, okay? Then it's a little bit easier. And let's go back to our initial zone. Oh, wow, you can see we formed a demand zone, right? We formed a demand zone, and before we violated the supply zone. Yes, this one is a flip zone that's more powerful, right, than a general zone. That's perfect. Let me remove this. The zone is original, it's a fresh zone, and also it is a flip zone. That's perfect. That was a practical application about originality and freshness. See you in the next one. Before we move on to the next zone qualifier, let's take a moment to explore flip zones and how they connect to freshness and originality. Flip zones are newly created zones that decisively break through opposing zones, signaling a clear shift in market control. For example, a new demand zone forms by breaking through an area of original supply. A new supply zone emerged after overpowering original demand. These zones are often stronger than original zones because they highlight a decisive takeover, where either demand or supply has completely dominated the opposing force. Flip zones often appear when price breaks out of a higher time frame trading range, where pivot points are broken. Flip zones represent strengths and dominance in the market. When paired with freshness and originality rules, they guide us toward higher probability setups. Next, let's talk about profit margin and why it's a critical factor in evaluating the quality of supply and demand zones. Simply put, profit margin reflects how far price has traveled away from a zone. The farther price moves, the higher the profit margin, which directly impacts the trade's potential risk to reward ratio. To determine profit margin, we measure the distance price has moved from the proximal line of the zone to the stop loss. This is where we assess risk to reward, RR ratio. Unlike the distal line, which defines the overall zone size, using the stop loss ensures we evaluate the true risk of the trade. This method provides a more accurate picture of the potential reward relative to the actual risk being taken. Profit margin is an objective and measurable metric, quantified as a key performance indicator KPI in trading. We use tools like Fibonacci retracement to measure this accurately, and I will walk you through that in the practical application. For now, let's review 3 examples of profit margin: great, acceptable, and not acceptable. Great case. Price has traveled a significant distance from the zone, exceeding a 1 to 5 RR when calculated from the proximal line to the stop loss. This creates an outstanding profit margin. Acceptable case. Here, price has moved a moderate distance, typically around a 1 to 3 RR. While it's not as strong as the great case, it's still considered acceptable for many trading strategies. Not acceptable case. In this scenario, price has barely moved from the zone, measuring 1 to 2 RR or less. Zones with this kind of profit margin are generally considered insufficient and should be avoided. That said, it's important to recognize that these examples are conservative benchmarks. Defining what's acceptable ultimately depends on your trade plan and management. For instance, 1 to 2 or even 1 to 1 RR can be perfectly valid if managed properly and paired with a corresponding higher win rate. As you gain experience and track your result, you may choose to adjust these benchmarks to align with your trading goals and risk tolerance. Let's once again head over to the charts for some practical application. Welcome traders to my practical application. Today we will talk about the zone qualifier profit margin. How far has price traveled away from our zone? That's the question here. We have to calculate also our profit margin. I will show you how to do this. Let's go into the Campus Fund trading platform. Yes, it is TradingView. We can execute and analyze all of our tools. Okay, let's start. That is our zone on the preferred version. Okay, and we have to calculate now from this zone here all the way up, because it's a demand zone, right, to the turning point, and that's here. Let's calculate the range between. Okay, we'll use the Fibonacci tool for that. We add this from the proximal to distal line, and I prepared already the numbers here. You can see that's 1, 2, 3, 4, and 5. This represents our rewards, risk to reward ratio, meaning this one here is 1, meaning a risk to reward ratio 1 to 1, 2 to 1, 3 to 1, 4 to 1. And you can see we read it above the 4 to 1, right? Easily. I mean, we could duplicate this one and put it on top. Then it's 8. I think it's almost 10 Rs, right? Risk to reward ratio 10. That's amazing, okay? If you calculate this from the initial zone all the way up to the turning point, that's great. That's how to calculate your profit margin. Great. That was my practical application about the profit margin. See you in the next zone qualifier practical application. Another key factor in evaluating the quality of a zone is arrival, particularly when trading lower time frame LTF zones in counter trend scenario. Arrival becomes crucial when you're going against the higher time frame HTF direction, such as shorting in an uptrend or buying in a downtrend. However, when your LTF zone aligns with the HTF trend, like buying in an uptrend or selling in a downtrend, arrival is much less of a concern. So, what does arrival mean? It refers to how price moves into our LTF zone and whether there are any obstacles, like opposing zone, that could limit the profit margin. This is especially critical in counter trend trade because we are already trading the weaker correction move. Ideally, price should arrive steeply into the zone, as seen in the first two examples. A sharp or steep move indicates there are no opposing zones in the way, allowing price to travel smoothly to a conservative counter trend target. This creates a cleaner, high probability setup. In contrast, a gradual move back into the zone is less desirable. When price moves slowly or stair steps into the zone, it often leaves behind opposing LTF zones. Even if these zones aren't high quality, they can still act as obstacles, making it harder for price to reach your target because you're trading against the trend's momentum. Now, when trading in the direction of the trend, arrival matters far less. Since you're trading with a stronger momentum move, price is more likely to break through any opposing zone. Momentum is your ally, making the path to your target much smoother and more reliable. We will do another practical application now to go over some examples. Welcome traders to our practical application. Today we will talk about the zone qualifier arrival, only necessary if we are in counter trend or sideways. Let's go into the charts. And here we are using our Campus Fund Trading platform. That's TradingView. We can execute and analyze all of our trades here. Okay, let's look to this zone, right? This is our demand zone, our rally, base rally. And of course, we have to check also the zone qualifier, arrival, but only necessary if we are in counter trend or if we are in a sideways trend. And remember guys, direction always on the higher time frame. I will change the time frame now from daily to the next higher time frame, weekly. Okay, and look at this here. We have a clear downtrend, high, low, lower high, lower low, lower high, and a new lower low. Meaning we would like to buy, right, for this example. And yes, arrival is important for us, but we have to wait, right? Price is here at the moment. We have to wait that price is more close to our zone. We can wait and we will discuss this later if we set this trade. But of course, we are looking for a clear drop, right? For example, the best would be just one candle, right? That would be the best. A really powerful move into our zone, and not allowed, or it is allowed, but hopefully without to create any opposing zones, no supply zones all the way down. That would be the best. Then we can maximize our profit margin. Okay, that is the idea. Of course, also multiple candles are allowed, but the best would be only one without any opposing supply zones. That would be great. Let's go to the daily time frame again. Here you can see what I mean again on the lower time frame, right? Here we need something like this without supply above. That's the idea. Great. That was my practical application about the zone qualifier arrival. See you in the next practical application. Before we wrap up, let's take a moment to consolidate everything we have covered. Here's a handy cheat sheet that summarizes all the zone qualifiers we've discussed. It's a quick and easy reference to help you evaluate zones with confidence. Feel free to take a screenshot so you can refer to it anytime. Having this guide at your fingertips will simplify the decision-making process and keep your analysis consistent. Everything we have just learned about refinement also applies to this next section. Before we conclude this lesson, I want to introduce you to an advanced zoned refinement method called the level on top of level, or simply LOL. This concept is one of the most important rules in the lower timeframe zoning process and plays a critical role in many of our trade sets. As the name suggests, a level on top of level refers to multiple levels stacked closely together. These stacked levels indicate areas of greater imbalance in the market, which often means a higher concentration of unfilled institutional orders. Think about it this way. Price has to break through one level first before arriving at the second level, the level you will trade. Price is, so to speak, exhausted from fighting through the first level, making it much easier for the imbalance in the second level to redirect the market. By understanding and identifying LOL zones, you will gain an edge in spotting high probability trade opportunities, making this a valuable tool in your trading arsenal. Let's dive deeper into how this works and, more importantly, how to apply it effectively. Let's take a look at this example. Here we have two levels stacked on top of each other. A rally, base rally, on top of another rally base rally. I'm going to show you how to objectively and mechanically determine whether these two areas can be combined into one, whether they qualify as a level on top of level, or LOL. The level closest to the current price is referred to as the proximal level, or in this case, level A. The key rule here is that level A must meet all the high quality zone qualifiers we have discussed in the lesson. This includes freshness, a strong leg out, a compact base, and proper context in terms of location. The lower level is called the distal level, or level B. The only rule for level B is based on the principle that everything that looks like a level is a level. Unlike level A, zone qualifiers do not apply to level B. It doesn't need to be fresh. The basing candles don't need to meet specific criteria, and the leg out doesn't have to be explosive, as long as it visually looks like a valid level based on one of the four formations we have learned. It qualifies. Now let's talk about the space between level A and level B. This is known as the white space, or area C. For the two levels to qualify as a level on top of level, the white space must be smaller than or equal to the size of either level A or level B. But here's the good news. You don't need to overanalyze or measure this precisely. A simple visual check is sufficient to determine if the levels are close enough. Now that we have identified this as a level on top of level, the next step is setting our entry and stop. There are three approaches, each with pros and cons. I'll also share my recommendation. Option 1, combine both levels. This approach merges both levels into one. Your entry will be at the proximal line of the proximal or first level. The stop loss goes below the distal line of the distal or second level. Pros, you're almost guaranteed to get filled. Cons, by combining both zones, you effectively create one large zone which reduces profit margin. Option 2, split the risk. Divide your position into two entries. One at the proximal line of the proximal level and another at the proximal line of the distal level. Pros, better risk to reward if both entries are filled. Cons, you run the risk of being inconsistent, as only one entry may get filled, leaving you with only half a position open. Option 3, trade the distal level. I suggest targeting the wider version of the distal zone. price often bounces at the proximal level before moving deeper to touch the wider version of the distal zone. Pros: this combines the best of both worlds, a high profit margin and a reasonable probability of getting filled. Cons: your fill rate is still lower compared to option 1, but experience showed me that this is a worthwhile trade-off, as more often than not price eventually reaches the distal level. Choose the method that fits your style, but stay consistent. Lock your trades, analyze results, and refine your approach. Over time, this discipline will guide you to the best strategy for your goal. Let's dive into the charts one last time during this lesson to apply what we have just learned. Welcome traders to my practical application. Today we will talk about the zone qualifier level on top of a level. Let's go into the Campus Fund trading platform. That's TradingView. We can execute and analyze all of our assets here. Okay, remember, this one is our setup, right? Our rally, base rally. We checked already in the previous practical application sessions all the zone qualifiers. Now we have to talk about the level on top of level scenario. For that, that's a demand zone, right? We have to check, or we have to looking for demand zones, other demand zones below our zone. And yes, surprise, surprise, there is something, right? A rally, base, rally. Let me identify this for you. I will change the settings. It was from the profit margin session. Okay, we just need one proximal and one distal line. Okay, you can see it's a clear profit, it's a clear level on top of level. We have just a little bit space between both zones. Okay, it's a level on top of level, and we have multiple ways how to trade this level on top of level. I will show you how. We move this to the current price, and we can see. Option number 1 is to combine both levels, okay, from the first proximal all the way down to the distal of the second zone. Let me add the long position tool. That's our entry, and this one is our stop loss. Of course, additional 33%, right, below the distal of the lower version here, of the lower formation. Great. Where's our target? Remember, guys, we are in a downtrend, a higher time frame downtrend. It is just a correction trade, okay? Here it's a little bit difficult to identify our target. We will go with this here, okay, just to calculate our profit margin. Later on, if I press the play button, then we can check our profit margin. Okay, that is option number 1. We combined both levels, right? Both levels. Option number 2, we will split our position size into 2 trades, 50% and 50%, half and half. The first 50% is the same like the option number 1. We combined both levels, but it's just 50% of our position size. Second one is, we will go with the second one. Only with the second one, okay? We move the entry, that's here. Okay, that is our another 50% of our entry opportunity, right? 50% here and 50% here. And now we have our last entry opportunity. That's only the second level. Let me explain the different entry opportunities. Here with option number 1, we combine both zones. Of course, the probability to getting filled is great. Profit margin, it's less compared to the other entry opportunities. The reason is the zone size. We combined 2 zones. Of course, it's a little bigger, right? Option number 2, we have 2 trades here, right? Probability to getting filled is great, but only with 50%. The other entry is lower, okay? Moderate probability to getting filled. Profit margin, yes, it's good. We have this one here with approximately 7 or 8 hours, right? Depends on our target. But again, just 50% here and here. Hopefully we're getting filled also with our second position. Then it's fine. Last but not least, our third entry opportunity. And here we will go only with a level below, okay? The full position size. Probability to getting filled, yes, it's less, but the risk to reward ratio is amazing, right? It's 8 hours. That is absolutely fine. Probability to stop out, yes, it is possible, right? But we are using here 2 zones, right? For all our entry opportunities. We are using 2 zones. Means we have a lot of institutional unfilled buying orders above our stop loss. I think that's a good way how to protect our money. Okay, let me press the play button. Then we can see was it a good decision to go maybe only with the option number 3 to take the level on top of level, or make the other entry opportunities a little bit more sense. Press the play button. Wow, that was quick. It was really quick. Let me stop this one and you can see, wow, we got a huge drop, and here we can also talk about arrival, okay? Look at this, how we arrived into our zone, really powerful. Our next opposing zone was here. This is a drop, base drop, meaning this is our target. Let me move all our targets here below, right? Here. And here, remember, it's a higher time frame counter trend trade, right? And look, arrival is amazing. Huge, powerful red candles into our zone. And yes, we got filled with the first position and also here with the second position on the entry opportunity 2, and also with the full position with our entry opportunity number 3. That's great. Here, it was definitely a good idea to go with a level on top of level and with a stop loss below, of course. We could maximize our profit margin, right? And the probability to getting filled was also great here because we hit our level below. Great. That was my zone qualifier practical application about the level on top of level. We also discussed how to trade this scenario. See you in the next practical application. You have reached the end of lesson 6. By now, you should have a solid understanding of how to objectively evaluate the quality of a zone. These qualifiers are essential tools that should form an integral part of your trade plan. As we discussed, it's up to you to decide which qualifiers to include and how much emphasis to place on each one. Let your trade log be your guide, helping you make informed and data-driven decisions as you refine your approach. With that, I will say goodbye for now. I look forward to seeing you in the next lesson, where we'll get into the different elements of a trade. See you there.